Okay, I think we can get started. Still some people joining, but I think we'll get the gist. Thank you everyone for joining us today. My name is Michelle Cremin. I'm an Associate Director here at Nest Insight. Many of you probably know that ordinarily at this time of year, we would be holding our annual conference. We're sad not to be seeing you in person, but delighted to be able to host this series of online discussions that we hope will build into a broader picture of the challenges facing the retirement system here in the UK and elsewhere. So yeah, very grateful to you for fighting the screen fatigue to spend your lunchtime with us, or indeed your breakfast if you're joining us from the States. If you're in any other country, I also hope you're enjoying a meal or at least a very nice snack. But of course, the biggest thanks go to our esteemed speakers today. Elaine Kempson is Professor Emeritus at the University of Bristol. Elaine has been looking at financial well-being since 2005 in the UK, but also in several other countries. And Laura Gardiner is Research Director at the Resolution Foundation, the independent think tank focused on improving the living standards for those on low to middle incomes. I will hand over to our expert guests in just a couple of minutes, but first, a few housekeeping things. This is our first webinar. I think the jury is very much out on that word. We know glitches can happen. We hope they don't happen to us, but please bear with us if they do. We will be back on the next 2 Wednesdays at slightly different times to make it easy for our international speakers to join us. So next week, our event is at 4 p.m, but all of the information is available at nestinsight.org.uk. Today, we will wrap up by 2 p.m. On a very practical note, if you currently see 4 equally sized boxes with the 3 of us and the slides, you can make the slides bigger by clicking on them. And you should also see a Q&A box. Please do submit your questions right from the start, or indeed anything else you'd like to add to the discussion. I think this is one forum where you're more of a comment than a question is also encouraged. Finally, if you're so inclined, you can tweet about this event using hashtag #NestInsightOnline. Next slide, please, Gwen. So if you've made it this far, chances are you have a decent idea of what Nest Insight is all about. But I just want to say a couple of things by way of framing this discussion. Nest Insight was set up to understand and help solve the challenges facing savers, and our ultimate aim is getting low and moderate income workers to a good retirement. This means we take a long view, but it's also a broad one. Saving into a private pension is vital for most people to get the outcomes they want and expect in retirement, but it's not the only determinant. We know that short-term financial shocks can have lasting effects on people's financial health, and much of Nest Insight's work is premised on that understanding that we must look at financial well-being in the round and with longevity in mind. Next slide, please, go ahead. So here at Nest Insight, we talk a lot about the defined contribution generation, that being the new population of savers brought in by the UK's auto enrolment programme. Nest now has more than 9 million members. There's a big range of incomes in there, as you might expect, but more than half earn less than £20,000 a year, and almost half of Nest members are under the age of 35. That is particularly poignant to me, having turned 35 yesterday. Just to have in your mind just some information about those groups, as Elaine and Laura talk about those adversely affected by the pandemic. It's also worth saying that we're concerned also with the retirement security of those not covered by auto enrolment. One of our major research programs is looking at how to help self-employed people to save, but we're also looking at other at-risk groups like those in precarious work, carers, and those with mental health conditions. We are adapting our research programme to fit this new reality created by Covid-19. But today's conversation is about really understanding what households are experiencing in this moment as a starting point for thinking about the kinds of policies and tools and services that might be needed to support people right now, but also in a way that sets them up well for the long term. So Laura, it seems to me like the team at the Resolution Foundation might not have had as much as a nap since lockdown began. You've been prolific. I think you're going to kickstart this conversation by helping us cast our minds back to the time before March 2020 and tell us a little bit about how we were doing on wealth and income equality.
Absolutely. So I will thank you very much for having me. I'll just spend a couple of minutes before we hear from Elaine on what's been going on in this crisis, talking about where we were on the way into it, on the basis of kind of key measures of inequality. For those of you not familiar with the Resolution Foundation, I should warn you, we really like charts, so there's lots of charts coming up. I will try and make sense of the headlines if you're not one for the colourful detail. So next slide, please, and one more, please. So as the title suggests, I'm just going to give kind of a couple of minute intro to where we were on wealth and income inequality going into this crisis. So we're going to start with income inequality, and when people talk about inequality, this is without saying what they mean. It's usually something like income that people are referring to. So it's kind of our best net household income is our best day-to-day measure of living standards. What this chart shows is a Gini coefficient, which is a common measure of inequality, a higher number meaning that society is more unequal, and it shows a couple of different measures of income inequality based on the Gini coefficient, with the consistent story from all. I won't go into the details of the differences between them. We've written a really long report about the differences, but it's not one for today. The key message coming from all these measures is that income inequality rose very rapidly during the 1980s and has basically stayed stable at that high level since. That high level is at the upper end of the International League table on inequality, not as high as the US, but higher than Canada and most European nations. Next slide, please. A little bit of good news within that story of high but stable income inequality over recent decades is there is some evidence that the inequality of income between regions of the UK has been falling. And this chart's got a few different lines on, but the one to focus on is the kind of gold-coloured line, which shows another measure of, this time it shows a measure of variation, so the level of difference in the incomes in different regions, and it shows that this measure of variation has been, seems to have been falling, at least over the course of most of the 21st century, and that is driven principally by falling employment gaps between regions. So Britain's jobs boom and move towards full employment pre-crisis had benefited previously low employment regions and helped close some income gaps. Nonetheless, despite these falls in between region income inequality, the UK remains one of the most unequal countries internally, regionally, in terms of regional inequality. Next slide, please. So if that's income, which I'll come back to in a sec, what is going on with wealth? And when I say wealth, I'm talking about household wealth. So we tend to focus on properties, housing, pensions, and financial wealth. Some people include physical wealth, like your cars and your jewellery too, which is a bit problematic to measure, but that's roughly what we're talking about. And what this chart shows, using yet a new measure and bombarding you with different types of statistics, here we've got a 1% and a 10% share. So these are the proportion of all household wealth held by those bits at the top of the distribution. And it shows that on this measure of inequality, on these two measures of inequality, wealth fell throughout most of the 20th century and has been kind of broadly flat over the course of the 21st, with some jumping around. Where we've ended up on this is top half, but not abnormally high by international standards. Certainly not as high as income inequality is, although the caveat to that is because different countries, as lots of you will know, have such different pension systems and property markets, international comparisons of household wealth are quite problematic. Unlike income, and as the note down the side says, there have been some increases in between region inequality on a wealth measure, and that's because of differential changes in house prices, with prices in London and the South growing very fast. But to take the overall message of this slide, wealth inequality falling then flat and not abnormally high by international standards, why is it something we really worry about in Britain? As the title says, concerns about wealth inequality have risen. So in my final couple of slides, I'll try and answer that question. Next slide, please. So I think this is the key and a really important but an undertold story about how Britain has changed in recent decades. Focusing just on the top line on this chart, what this line shows is total household wealth as a ratio to national income, so the total income or GDP of the country, and it shows that that ratio was kind of flat at about wealth being about 3 times national income for much of the 70s and 80s, and then it has shot up to 7 or 8 times income. So what that means, what that technical thing means, is that wealth, the value of our houses, our pensions, and our financial wealth, has been going faster than what we earn in our household incomes. For a number of decades in Britain, wealth has outgrown income. And what that means is that even though these relative measures of inequality I've been talking about haven't shot up, absolute wealth gaps have been rising really rapidly in this country. And I think that's really important. And at the bottom of this chart, I've got a point saying that the taxes haven't kept up with that wealth, but that going into detail on what those are is for another day. So I'll go on to my final slide, please. So taking away this key finding that the growth of wealth has outpaced the growth of income in Britain, I think the reason why British people are very and increasingly concerned about inequality, despite the fact that on both measures of wealth and income it hasn't got worse, is that what it means to be well off in Britain has become so much more related to what you had to start with, what you inherited, the value of your house and so forth, and how the value of that grows, than what you're capable of earning, that the gaps have got larger and your ability to move around the wealth distribution has become more limited. And this chart tries to demonstrate this with a slightly complicated measure of the wealth gaps in different countries in relation to the typical income in those countries. And this shoots Britain right up to near the top of the league table, because our wealth gaps between somewhere near the bottom of the distribution and the upper middle are so much larger than what a typical household has in income each year. So I think that's my key message on inequality in Britain. The trends are not always moving in the direction that the kind of public discourse, public narrative on inequality might suggest, but the massive growth of wealth in Britain, and therefore the increase in absolute wealth gaps, means what it means to be rich and well off has fundamentally changed, and households' ability to move up into richness without having some wealth to start with has got much less likely. And I will stop there for now.
Thanks so much, Laura. I think it's really useful to have that grounding in those disparities and the challenges that existed before we got to this new set of challenges. Elaine, you've been leading the coronavirus financial impact tracker supported by the Standard Life Foundation. Could you talk us through what you've seen as the crisis unfolds?
Thank you very much, and good afternoon, everybody. The effects of the lockdown in response to COVID-19 were immediate and really very large, and they covered all parts of the country to a pretty much equal extent. So within 3 weeks, a quarter of all households in the UK, that's about 7 million of them, had lost earned income, and almost 1 million had submitted a claim to universal credit. So that's the backdrop. Could we have the first slide, please? The impact of all of this, as measured from the Standard Life Foundation Tracker Survey, is that in early April, the financial well-being was quite clear. Only 35% of UK households were financially secure, and I should say we measured that using 9 questions covering ability to make ends meet and financial resilience. So how well people were managing, but also what resilience they got in order to enable them to continue to manage. So only 35% were financially secure. At the other end, however, almost as many were showing signs of financial strain, with 17%, that's 4.8 million, struggling to make ends meet, and 11%, 3.1 million, in really quite serious financial difficulty. Moreover, we estimate that each of those figures had increased by about 4 percentage points in those 3 weeks. So that, for example, those in serious financial difficulties rose from 7 to 11%. The next slide, please. Next slide, thank you. We can get an idea of the extent of the problems being faced by those in serious financial difficulty if we take a look at some of the questions that went into this composite score. We can see that 9 in 10 were struggling to pay for food and other household expenses, or had been struggling in the last 4 weeks. All were struggling to pay their bills and credit commitments, and the vast majority of those, it was a constant struggle. 2/3 admitted to being in arrears with bills or credit commitments, and 1/3 of them were in arrears with 3 or more types of commitment, and we just measured types, not all, and the number of commitments in total. And in order to make ends meet during the past 4 weeks, 3 in 10 of those in financial difficulty had used savings. But what is interesting is almost all of the rest had had no savings they could draw on, which I think probably helps to explain why more than 6 in 10 had used credit to buy food, pay for other expenses, or to pay their bills or keep up with credit commitments. Next slide, please. Although it took a while to set them up, the government introduced far-reaching job retention schemes for both employees and the self-employed. But the big question really is, how well have these schemes worked? Well, 2 months after the lockdown was introduced, the May Tracker survey showed that over 4 in 10 households had seen their jobs affected in one way or the other by the pandemic. 15% were having their earnings met in full, primarily by the furlough scheme. So although they were not working, they were getting their wages fully covered. And these people we've called the protected. But an almost equal number, indeed slightly more, which is about 4.5 million households, had seen their incomes fall despite being furloughed or receiving the self-employment income support grant. Those we've called partially protected. But perhaps even more significantly, 11% of households had not been covered by either of the schemes. They didn't qualify for either of them. And only 1 in 10 of those people have been able to claim universal credit. So a sizable number of people, 3 million households, in fact, who had been left unprotected. And I'll come back to each of those groups. Next slide, please. The effects of these shortfalls amongst those who were furloughed or received the self-employment income support grant had a drop, and those who were quite unprotected, they're quite clear to see in the May Tracker survey. So that a quarter of those who had not qualified for either of the schemes, the unprotected groups, were in serious financial difficulty. That's the red bar that you can see here. And a further 2 in 10 were struggling to make ends meet. So nearly half of them facing financial difficulty. But interesting, the situation for those with the furlough or self-employed income scheme had covered part of their earnings shortfall was actually only marginally better. So that 2 in 10 of these were in serious financial difficulty. These are the partially protected group, the red bar again, and another quarter was struggling to make ends meet. Next slide. Looking to the immediate future, we asked people we asked them a whole raft of questions actually about how well they expected to be able to manage. And from this, we created a composite score. But here I'll look primarily at the question about how likely people thought it was that they would experience an income shock in the next 3 months. And 1 in 8 of all UK households thought it very likely that they would lose income. And that's being up to the beginning of August, mid-August rather. And slightly more of them expected to experience job loss or to cease trading altogether than expected to see reduced earnings or reduced hours. And more particularly, these figures were very much concentrated amongst those who had already experienced a fall in earnings. So that you can see that there was partially protected, about nearly 4 in 10 of them expected to lose earnings. And moreover, about equal numbers expecting job loss or to have a fall in their income. Amongst the unprotected people who were left currently with no coverage by either of the government schemes, there we see that many more of them were expecting to lose their job altogether. So one can assume they'd had a fall in earnings and now, or a fall in self-employed earnings, and now were expecting to lose their job completely or to have to give up self-employment. Just as a comparison, we can see that the people who were protected by the furlough scheme, primarily it was the furlough scheme in their case, very few of them expected to lose their job. So what it seems to be that for some people, furlough and self-employed income support grants were protecting people now, and those people had the most secure future going forward. The ones already hit or the ones who will be hit further. Next slide, please. So who's been most adversely affected? If I start with those who have been covered by government schemes, it's clear that manual workers were most likely to be furloughed, and those working in construction, hospitality, and arts and entertainment were the ones most likely to be furloughed, but to have seen a drop in their earnings despite that. And so too were part-time workers and those working in the gig economy. They also had seen a fall in their income. It's also quite clear to see that self-employed people covered by the Self-Employment Income Support Grant Scheme were almost invariably left with a drop in earnings. And this compares with only 4 in 10 of those who had been furloughed who had seen a fall. But in comparison, if we look at those households that have been left completely unprotected by government schemes, we can see these people were less likely to be manual workers. They included, relative to those being furloughed and hadn't had a fall in income, a much higher proportion working in arts and entertainment, and interestingly in the education and social care sectors. And I think the answer to that lies in the fact that they included a higher proportion who were reliant on self-employment for earnings, or they worked in the gig economy. So they were contract workers, or they found work through an agency or an online platform. And all these groups on this slide were the people who were most likely to say they would expect another economic shock. If we now turn briefly to the types of household with the lowest levels of financial well-being currently and the poorest prospects for the future, most likely to be hit by income falls, there were families with children overwhelmingly, and especially lone parents. They included those where the head of household had a disability that limited their daily activities, and tenants of all kinds, but of course social tenants in particular. And the next slide. This slide shows that none of this was inevitable. Identical surveys were run in Norway and New Zealand, and in all 3 cases, 3 weeks after the lockdown in that country was introduced. And all 3 governments had introduced similar job retention schemes. And we can see from this that while levels of financial well-being in the UK and New Zealand were very similar, they were infinitely better in Norway. And indeed, they still are. Next slide. And I'm going to leave you to ponder on why that should be the case, and maybe we can return to that in the questions later. Thank you.
Thank you, Elaine, and I'm sure that our audience will want us to take that bait. So we'll come back to that. But before we move on to Q&A, Laura, are there things you want to add to that from your work at the Resolution Foundation?
I will do, but very briefly, because you've all endured lots of charts from both me and Elaine, but I'll just give you a few more. This really builds on what Elaine said. Previously, I talked about where we were before the crisis, and I'll just show you a little bit of evidence from our own survey that we did in early May on what's been happening. So this is absolutely what Elaine was just telling you. When we think about what's happened in the labour market, furlough, job loss, or loss of hours associated with loss of pay, our key finding is that these things are much more likely to have happened to those in families with lower net family income. So this is just the working age distribution. So this is excluding, all this analysis I'll show you excludes pensioners. Next slide, please. But when we switch from focusing on those labour market hits, those direct hits to earnings, and look at families' assessment of the changes in their net household income, we see a much more even pattern across the distribution. So yes, there are differences with families towards the top of the distribution, slightly less likely to say their income has decreased, but also slightly less likely to say it's increased. But but this is really quite an even picture compared to the first picture I showed you on the labour market. And the two reasons for that are, first, that lots of families towards the bottom of the income distribution don't have many or any adults in work, so just aren't exposed to the labour market hit. And secondly, our progressive tax and benefit system has, as it would be expected to, done a good job of protecting the bottom of the distribution from these labour market hits. And the £20 a week increase, the value of universal credit and other changes to benefits will have helped there, including by boosting the incomes of those at the bottom of the distribution who didn't experience the labour market shock, for example, because they weren't in work in the first place. So I think that's, obviously we can do better, but that's quite good news for our social security system. On to the next slide, please. When we look at spending, families' outgoings, we see a much starker distributional picture, with those at the top of the distribution much more likely to have reduced their spending during this crisis. Now, that's not really surprising. We know that they spend more money on essentials, and we know that they spend more money on things that were effectively ruled out by the lockdown, like eating out and arts and leisure activities. Now, that might be tough for those who enjoy and expect to do those things. But when put together with the income changes we've just described being quite even, it creates a very different picture across the distribution in terms of what's happened to household balance sheets, which we can see on the next slide, please. So this is our attempt to put together the story I've told you on income changes with the story I've told you on spending changes. It looks at the proportion of families in each income quintile. Again, remember, this is just working age, who have experienced no income hit. So income either staying the same or going up. So that might be people who've been able to shift their work from home. Nothing else has really changed on the income side, but have seen a spending reduction. And that's 3 times as likely for the highest income quintile as the lowest income quintile. So again, it's not a great thing that people have been restricted from spending money on what they want, but in terms of families' balance sheets, it's those at the top of the income distribution who are most likely to have seen an improvement. And then onto my final slide. And what that means, or another aspect of that focus on balance sheets, is it's those at the bottom of the income distribution who have been most likely to have taken on debt. And we see a similar story when we look at changes in savings rates across the distribution. What this chart shows here is whether during the coronavirus crisis, families have taken on more debt, and it shows the type of debt. So the overall pattern for all the bars is taking on debt being more likely at the bottom. And for the highest cost forms of consumer credit, which are overdrafts and credit purchases, they tend to be higher cost in terms of servicing that debt than credit cards and personal loans. We see the distributional skew is greater. So you can see that the blue bars, for example, are bigger in the second quintile than the first, but the red and the green bars are as big in those 2 quintiles. So bringing all this together, and I will shut up and not show you any more charts. When we look at income and spending changes in this crisis, we see improved balance sheets mainly for better off working age families. We get a very similar picture if we look at savings rates and debt, with lower income families being more likely to take on debt and the lowest income families being more likely to take on the highest cost forms of debt. And I think understanding that, which is incredibly complementary to, I think, to what Elaine's told you, should make us think about how families' wealth, balance sheets and pensions are going to look as we go through this crisis, what government support should look like in the next phase. And when we get to the point of saying, if we need some consolidation and some taxes to rise, I think it should force us to think hard about what kind of taxes on what kind of things, richer or poorer households, income or wealth, etc., are the ones that should be picking up the slack. That's all from me.
Thank you, Laura, and we love the charts. Thank you both for a really comprehensive overview of the challenges facing households at the moment. There are some questions coming in. Please keep them coming. In the meantime, I will use my chair's prerogative to ask a couple of questions of my own. I'm actually going to fold in one of the audience questions to this one to Elaine. So somebody's asked what time period your research covers. I wondered if you could tell us kind of what the plan for the coronavirus financial impact tracker is, and kind of what you expect or what you suspect we might see over this next 6 to 12 months?
Okay. So far we've done 2 surveys, one 3 weeks after lockdown in April, a second one a month later in May, and we're just about to go into the field next week with the third to get a baseline before the furlough scheme begins to change. I anticipate a slight deterioration in that time, but I'm expecting it to really speed up from now and from October onwards, really to see a rise in the proportion of households in difficulty. And from that point on, we've yet to decide exactly where we will survey, but we'll be surveying periodically for at least another 4 waves.
Great, and we will share links to everyone's work after the event. One more for you, Elaine. To the extent that you've been able to think about kind of savings in this time, when and how do you think we should start encouraging that or start thinking about it?
Well, some people are in a very good position to start now, of course. As Laura was saying, the home workers and people furloughed who've furloughed on full salary, who've seen a massive reduction in their outgoings, particularly outgoings related to going to work, are in a very good position to save, and indeed are already doing so. But for others, I think the awareness of the need for saving will outstrip their capacity to do it. So I think those who've been really badly hit will be well aware just how important their savings were if they had them, and how good it would have been to have had savings if they didn't. But their ability to do something about that will be constrained, I think. So it's a mixed picture. But you know, it's interesting. I think about 4 in 10 of the workforce are currently working from home. So those people have seen quite a dramatic fall in their outgoings.
Thank you, Elaine. Laura, kind of keeping now on a savings theme. I think in the past you've been supportive of moves to expand auto-enrolment, its coverage, and think about things like calculating contributions on the first pound of pay. And there's perennial debate in pension circles about increasing minimum contributions beyond that 8%. Just wondering, kind of, what do you think about where those discussions go now in the context of COVID-19?
Yeah, I think that's a really good question, and I think there's, you know, the kind of the debate at the moment risks getting forced into sort of 2 camps. One camp which says this moment of disruption provides us the opportunity to do all the things we've wanted to do for ages right now. It's the sort of the opportunity for revolution approach. And there's another camp which says there's the biggest economic crisis probably in 300 years going on. Forget your wish list. Like, that's all off the table for a while. It's just not the problem right now. And I, unsurprisingly, I'm sort of going to try and be in the middle of those 2 camps. So I do think, obviously, you know, the realities of what we set out, particularly with regards lower earners and those at the bottom end of the income distribution, mean that times are really tough, and times are tough for firms as well. So pushing particularly hard on some of the stuff we were talking about beforehand is going to be wrong-headed and has the potential to destabilise more than we would like. On the other hand, there is a given the particular nature of this crisis and our reliance on key workers, and particularly workers in sectors like social care and food retail, there is a new debate forming on a new settlement for the low paid, and we published a report on this last month, a month ago. So I do think there is I do think now is the right opportunity to be thinking about some of these challenges around rights, security, and longer term security in the form of pensions for the low paid. So I think when it comes to some of the things we were talking about before the crisis, the changes to auto enrolment that the government sort of said it's going to do anyway by the mid 2020s, and some more eligible employers to be the next group to make greater contributions within auto enrolment. I think that, especially come the autumn, when we're talking about things like funding for the social care workforce in the budget, those things shouldn't be off the table. So that was a long-winded way of me saying we've recognised the value of some of the lower paid work in our society in this crisis. So I think there's a good opportunity to think about how auto enrolment can better serve low earners in particular as we come out of it.
Yeah, I think that's a really helpful answer. And just one more question for you, I think. Actually, Elaine, you're welcome to join afterwards. Given the kind of the groups, the disparity in effects, and the fact that different groups are experiencing this in very different ways, and some people actually coping pretty well and potentially getting better off in this time. How do you think policy and industry responses should differ? Either is there a policy framework or potentially kind of products and services that could take into account the different effects that people are experiencing?
That's a really good question. I think the key difference in this crisis compared to previous crises in the labour market is its highly sectoral nature. So the lockdown clearly affected some sectors much more than others, with kind of hospitality, arts and leisure, and non-food retail basically shuttered. And that sectoral differentiation will continue in the reopening phase, with ongoing social distancing continuing to affect output, supply, and capacity in those sectors, whereas others can kind of get back to normal pretty quickly. That sectoral differentiation is much bigger than in previous crises, at least 6 times as big as in the financial crisis when we look at the sort of differences, and that's what drives the types of people who are most affected, like the low paid and younger workers. So that sectoral differentiation, we've been arguing, should be reflected in the government's response. So thinking differently about, for example, how it withdraws the job retention scheme, or whether it offers wage subsidies or anything like that, or tax breaks in different sectors, given the very different jobs hit. And we sort of saw a bit of that from the government in terms of a sector-specific VAT cut last week and the ETAP to help out vouchers. Less of that sectoral focus on the labour market side of the government's response. So to get to my point, we've been really encouraging the government to think differently in different sectors as this crisis moves forward, and they've done a bit of that, but we think they could do more on the labour market side. And I think the challenge for the pensions industry, other aspects of policy that relate to the labour market, will be to do the same. And that's really hard, because it's much easier to not have to think complex questions about which sectors are in and which sectors are out. But there may be a case, for example, to push differently on aspects of auto-enrolment or other aspects of pensions policy in some sectors than others, especially in the kind of pre-vaccine equilibrium we're now going into, where some key low-paying sectors in our economy are going to continue to really struggle.
Elaine, is there anything you'd add to that question, to kind of how we need to change policy and products and services to cater to the differing needs?
I don't think there is. I think it was a very comprehensive reply that I would endorse.
Perfect. That's great. I will now turn to some of the brilliant questions that we are receiving. Bear with me as I deal with our software. So there is a question here, which I will paraphrase, as again is my prerogative, about how, as you probably know, in the US and in Australia, there's some ability to access pension savings in a crisis. So in the US, they've kind of increased the amount that you can draw down penalty-free as part of the CARES Act to kind of deal with the COVID-19 crisis. Is that something that we should look at here in the UK, letting people have access to their retirement savings? I'll go to you first, Elaine.
I think probably not, and I would say in support of that at the Pension Guidance helpline at the Money and Pension Service, they've seen a decline in the number of inquiries about people wanting to access their pensions. So it suggests there isn't much appetite for doing it, and that people see them quite differently. I feel we should at all costs try to protect pension pots. And I know from my Australian friends, they don't think it's a good policy.
Or any differing or similar thoughts?
I'm probably on Elaine's side. I think it's helpful to think about more flexible savings vehicles, but there are real risks to that, and I don't think I know there's lots of other aspects to it, but I don't think things like the lifetime ISA are a great advertisement for kind of how we might do these things and how they might be governed. But the thing I'd add to what Elaine said is any further loosening of restrictions on what a pension is and what it can be used for beyond the pension freedoms we already have further calls into question the preferential tax treatment of pensions in comparison to other savings. So if we, there's lots of good reasons why pensions are treated preferentially by the tax system, such as wanting to encourage people to save for the long term, but also the fact that it's a very restricted way of saving. If we remove those restrictions, we've got a weakened case for those tax advantages, and so that might make the whole thing harder, essentially.
That makes sense, and I think you're probably both aware of the work that Nest Insight is doing, where we are trialling whether adding a liquid, accessible savings pot to pension saving would actually make people more financially well in the short run and into retirement. Kind of tax questions aside, and assuming we can come up with a tax framework that works for that, is that something you can see an increased need for now? It's a very leading question, but welcome all thoughts. Elaine?
Sorry, I have to wait to be unmuted, which is why I'm a bit slow in answering. Yes, it's a short answer. Yes, I do think there is, and I've long been advocating it.
Laura, any other thoughts? Hopefully I'm unmuted now. I think I'm competing to unmute myself with someone else, which is causing all kind of confusion. These things are definitely worth exploring. I think as part of our intergenerational commission, which we ran a couple of years ago, we toyed around with other kind of analogous ideas where you can sort of get young people to have a pot of wealth early, but which is restricted to some uses, including pensions and house purchases, but isn't as restricted as a pension is. And I think I'm sympathetic to kind of sidecar savings type ideas. So definitely think it's worth exploring. And I think that the behavioural change, the really welcome behavioural change that pension reforms in recent years have brought about, not least auto enrolment, is good to capitalise on, and in order to get people potentially saving alongside in other ways. But I think I guess I'm saying, and maybe Elaine is too, it's important not to throw the baby out with the bathwater in doing so.
All right, now I'm muted. Absolutely, I agree with that. I'm going to address a couple of questions that I think are actually for probably me as a Nest person, although any other insights are welcome, which is any evidence of members opting out or any other kind of member behaviour. And I would just say that so far the impact has been really small, but we are conscious that the job retention scheme is probably acting as a bit of a buffer right now. So we'll be keeping a really close eye on that as that starts to wind down. Another question here is, have you done any research on what proportion of those struggling are most affected by, have you done any research on what proportion of those struggling the most from the crisis are from ethnic minority backgrounds? So that's something you've been looking at, Laura.
Okay, there we go. We have looked at that a little bit, and others have too. I think the evidence around both ethnicity and gender, from my reading, is a bit mixed coming out of the different surveys going on. So there definitely are some surveys showing bigger effects for minority ethnic groups in terms of furloughing and job loss. Our analysis shows that particularly in the case of Pakistani and Bangladeshi groups, less so in the case of other ethnicities. And the gaps aren't as big as we might have predicted, and the same is true of the differences between men and women. I've seen other studies that show much clearer differences. So I think it's an area that definitely needs more work, but I will defer to Elaine, who might have looked at it a little bit more than I have.
No, I can't really add anything much to that, I'm afraid. Unfortunately, the tracker survey ethnicity question isn't the very best one to be using to do this analysis, as I'm sure Laura knows. So I think we'll have to look to other surveys to look at it. I'm pretty sure we will see big ethnic differences opening up as we go forward. I think what's striking about what happened in the early weeks is that it just seemed to hit across the country in equal measures. So all the things we were accustomed to seeing in previous recessions were not. The lockdown hit it sort of almost indiscriminately. And as a consequence, I think we will see bigger differences opening up, but we don't see them in the way you might have expected up until now.
Thank you both. So there are a couple of questions about self-employed people and gig workers as being the most negatively impacted. They are also the groups least likely to be saving for retirement pre-crisis. What can we do to stop the long-term financial security gap widening between the traditionally employed and the self-employed or the gig workers? Laura?
I think that diagnosis is correct from our analysis, looking at kind of our timely survey and others, and the sort of official labour market data that's just starting to come through. It's clear that the self-employed are much more likely than employees to have stopped work, and were much more likely to report big income hits in the data I showed you earlier. So that's really worrying. I think to sort of think about the future and think about it slightly more broadly, the flip side of this is that the self-employed income support scheme that's just been started to pay out, on the one hand, it excludes quite a few groups, such as the newly self-employed and those paid in dividends. So there are some groups that will suffer hugely and really fallen through the cracks. On the other hand, essentially writes a cheque of up to £7.5 grand to people who've suffered very little income hit at all, which is why Rishi Sunak signalled that the quid pro quo for that would be a review of the treatment of the self-employed in the tax system in the future. So I think, I mean, it's so challenging, and I haven't even spoken about gig workers beyond the definition of self-employment, and our analysis shows that when it comes to sort of other definitions of gigging, like 0 hours agency, labour market hit hugely concentrated in those groups, and that, as I said before, reflects the sectors they've worked in. So in terms of kind of more security for the self-employed in future, I think this crisis has underlined the need for that. The government's had to sort of invent a very clunky grant system to sort of help some of them over and above what's needed and completely leave others out. So I support the Chancellor's intent to equalise the tax system between the treatment of employees and the self-employed. I think that's a necessary quid pro quo for what has been quite a generous grant scheme for some. But alongside that, we should be thinking about how further improvements to their welfare rights and security. So the state pension has been a good move for the self-employed in recent years, but should they get some form of sick pay? Should they get job seekers allowance, better maternity and paternity rights, and ways to save into a pension that are analogous to auto enrolment? Yes, let's talk about that alongside this conversation on fairer tax.
Thank you. Elaine, actually, in addition to adding or giving any other thoughts to supplement what Laura said, have you seen anything in the tracker about kind of people starting to turn towards it? Do you think we'll see an increase in gig work and self-employed work as people try to draw on new sources of income?
Well, my answer to your question was that we ought to see a reduction in it. I mean, our labour market flexibility, I think, has gone too far, way too far, and we can now see the consequences of that. And part of the answer to my question about why has Norway done so much better is that they've got a much more secure labour market. Only 5% of people in their tracker are either self-employed or in the gig economy. In UK, it's 20%. Yeah, that's a huge difference. And I think we must use this opportunity to look again at the insecure end of the labour market. And I'm not trying to find solutions to supporting it, but really looking at should it exist to the extent that it does. I know for some people it suits them, but for an awful lot it doesn't. And there is quite an overlap, not just that some of the gig workers are notionally self-employed, but there are people piecing together an income from a plethora of jobs, including insecure employment and insecure self-employment. And that we really do need to look at that and question whether that is the way to be running a labour market.
Thank you, Elaine. I'm conscious of time. I think what I'll do is maybe ask you each one more question, and if you want to add any kind of final thoughts or solve everything as you do that would be brilliant. So the question I'm going to ask for you, Laura, is there Much evidence yet on the role intergenerational transfers are playing in helping individuals weather the financial shocks and the implications of that for inequalities?
That's an excellent question. So, and it sort of pre-crisis intergenerational transfers and the role they play in living standards and inequalities was something I'd done a lot of work on. I think that the sort of the headlines of that are, along with the kind of growing importance of wealth in our society that I talked about at the start of my presentation, has been the growing importance of gifts and inheritances. So that wealth, that ballooning wealth, has been so much people can't consume it in their lifetimes or choose not to and hand it down to their kids, which is a positive boost to the living standards of younger adults, but risks widening intra-generational or wider social inequalities if you're, as I sort of alluded to earlier, if your living standards depend more on what you're going to get for your parents than what you can earn in the labour market yourself. So pre-crisis, intergenerational transfers were growing in Britain along with the growth in wealth, and they risked widening certain absolute wealth gaps within generations and across society. The only data I've seen during the crisis is some interesting data we did collect on our survey in terms of whether people have moved back in with their parents, and there seemed to be a cohort of kind of millennial professionals in London. I ended up on various Zoom calls with lots of them in various meetings over the last 3 months, going back to their parents' houses that have gardens, and that, like, partly that reflects the fact that lockdown, the kind of city living we were all used to, was like less appropriate in lockdown, but it increases the gap between those who can do that and go back and stay in a room at their parents' houses and those who can't. So we've got a snippet of evidence from the crisis suggesting that some of those intergenerational transfers of wealth and resources have benefited some more than others, and that reinforces a finding from before the crisis that wealth transfers, well, there's lots of good reasons to encourage families supporting each other. If that's our only solution to the long-term living standards challenges that young adults are facing, we're staring down the barrel of higher inequality and lower social mobility in future. So the jury's out on this crisis itself. There's some signs from the early parts, but we should not be relying on that as the solution to many younger adults' living standards in the challenging times to come, unless we want lower social mobility and so forth. And I've talked enough, so I don't think I've got anything else to add to wrap up. It's been a very interesting discussion.
That's brilliant. Thank you, Laura. And Elaine, you've mentioned labour market differences, but I wondered if you wanted to give us any kind of closing thoughts on what Norway has that we don't have.
An awful lot. Well, first of all, their government acted quickly, really quickly. Whilst we were still trying to work out how to operate the furlough scheme, those that come in had already been introduced, and it was introduced 100% of wages. So more generous and quicker. Their social security system is a social insurance one, much more generous. You get 2/3 of your final salary if you're unemployed. And moreover, that was increased, and increased immediately after the lockdown. So a much more generous welfare state. We've already seen that, mentioning the labour market is far, far more secure. Many, many fewer people in precarious employment, and many more people with a decent pension, I might say, as well. And lastly, back to where we started with Laura, income inequality in Norway is very, very low. They have one of the lowest Gini coefficients of the developed economies, and they've also got very, very low wealth inequality. And that showed even in our survey, with the proportion of households that had more than 6 months of income, of their February income and savings. And in Norway, that was 38% of all households. In the UK, it was 24%. So Norwegians are more secure. Their wages are higher, but the cost of living is higher. It's not higher wages. It's a much more secure labour market, a more generous welfare state, which is paid for by higher taxation.
Lots to aspire to there. Thank you both so much for both making the time today and for all of this work that is invaluable to so many of us. And thank you to everyone who's joined today. Sorry that we didn't get to all of the questions. I can just encourage you to join our future events. So next week we're back at 4 p.m. with Wendy De La Rosa from the Common Sense Lab in the US and Heather Kappas from LSE, as well as a couple of my colleagues on the Nest Insight team, talking about the kind of what behavioural science can do to support us out of this crisis. And yeah, we would love to get your feedback on this. I'd love to hear from you if you're interested in collaborating with Nest Insight or indeed supporting our existing work. But for now, thank you so much and see you again. Bye-bye.
Thanks a lot. Bye-bye.
Thanks, Elaine. Thanks, Laura.